Are dividends actually a smart investment, or are they just slow money for old people? If you're new to investing, you've probably heard of dividends, but are they really worth your time and money? Today, we're going to dive deep and give you the real answer, based on how dividends actually work and how they can fit into your investment strategy. We'll break down everything you need to know about dividend investing specifically for beginners. This video is for you if you're just starting out and have little to no prior investing knowledge. Our goal is to make this topic simple, clear, and actionable. Stick around because understanding dividends could completely change how you think about building wealth and generating passive income. Let's get started. First things first, let's define what dividends actually are in the world of investing. At its core, a dividend is a portion of a company's profits that it chooses to distribute to its shareholders. Think of it like this. When you own stock in a company, you're a partial owner. If that company makes money, it has a few options for what to do with those profits. One option is to reinvest the money back into the business to fuel growth. Another option is to share some of those profits directly with the people who own the company, the shareholders. This distribution of profits to shareholders is what we call a dividend. It's essentially a thank you or a reward from the company for holding their stock. The most common way companies pay dividends is in cash. This cash payment is typically deposited directly into your brokerage account. Sometimes companies might offer an alternative payment method, such as additional shares of stock instead of cash. This is often done through a dividend reinvestment plan, or DRIP. Companies that typically pay dividends are often well-established and consistently profitable. They might be mature businesses that aren't experiencing explosive growth, but generate steady income. These companies have reached a point where they can afford to share their earnings with investors, rather than needing to reinvest every dollar back into rapid expansion. Understanding this fundamental concept is the first step to understanding dividend investing. So, with that definition in mind, are dividends actually a good investment? The honest answer is it depends heavily on your personal financial goals and investment strategy. There isn't a single yes or no answer that fits everyone. Let's look at the potential benefits, the pros of dividend investing. One major advantage is the potential for a regular income stream. Dividend stocks can provide you with periodic cash payments, often quarterly, which you can use as income or reinvest. This can be particularly appealing if you're looking for passive income. Another significant pro is the power of compounding through dividend reinvestment. When you reinvest your dividends, you buy more shares, which then generate even more dividends. This creates a snowball effect, allowing your investment to grow exponentially over time. Compounding is one of the most powerful forces in investing. Dividends also contribute to your total return on an investment. Your total return isn't just about the stock price going up, it also includes any income you receive from dividends. Over the long term, especially with reinvestment, dividends can make up a significant portion of your overall investment gains. This is a crucial point often overlooked by beginners. Furthermore, a company's decision to pay and consistently increase dividends can be a signal of financial health. It suggests the company is profitable and confident in its future earnings. Paying dividends also shows a commitment from the company's management to returning value to its shareholders. This can be a sign of a stable and well-managed business. However, there are also potential drawbacks or cons to consider with dividend investing. One significant factor is tax implications. Dividend income is typically taxable, either as ordinary income or at lower qualified dividend rates, depending on how long you've held the stock. This means you'll owe taxes on the money you receive. Another risk is that dividends are not guaranteed. Companies can reduce, suspend, or eliminate their dividend payments if their financial situation changes. This can happen during economic downturns or if the company faces specific business challenges. Relying solely on dividend income without understanding this risk can be problematic. Dividend stocks may also not outperform growth stocks, especially in the short term. Companies that pay dividends often prioritize stability over aggressive expansion. Growth stocks, which reinvest profits back into the business, have the potential for much faster price appreciation. If your primary goal is rapid capital growth, dividend stocks might feel slow. Finally, successful dividend investing requires research. You can't just buy any stock that pays a dividend. You need to understand the company's fundamentals. You need to assess its profitability, its ability to continue paying dividends, and its overall financial stability. This requires more effort than simply buying a broad market index fund. So, while dividends offer income and compounding potential, they come with tax considerations, the risk of cuts, potentially slower growth than some alternatives, and the need for due diligence. The goodness of the investment depends on how these factors align with your personal situation. If you decide that dividend investing aligns with your goals, there are a few key metrics you absolutely must understand. These numbers help you evaluate the health and sustainability of a company's dividend. Ignoring these can lead to poor investment decisions. The first essential metric is the dividend yield. This tells you how much dividend income you receive relative to the stock's price. It's calculated by taking the company's annual dividend payment per share and dividing it by the current stock price. The result is expressed as a percentage. For example, if a stock pays $2 per year in dividends and its price is $50, the dividend yield is 4%. A higher yield means more income relative to the price. However, you need to interpret dividend yield with caution. A very high yield might signal that the stock price has fallen significantly, potentially due to underlying problems with the company. A yield that seems too good to be true often is. It could indicate that the market expects the company to cut its dividend. The second crucial metric is the payout ratio. This metric shows you what percentage of a company's earnings or free cash flow is being paid out as dividends. It's calculated by dividing the annual dividend per share by the company's earnings per share, EPS. A lower payout ratio is generally preferred. A lower payout ratio suggests that the company is paying out a sustainable portion of its profits and has room to potentially increase the dividend in the future. It also means they are retaining earnings for reinvestment or a safety buffer. A high payout ratio, especially above 70% or 80%, can be a warning sign. It might indicate that the company is paying out too much of its earnings, which could be unsustainable if profits decline. A very high payout ratio could also mean the company isn't reinvesting enough back into the business for future growth. This is particularly true if the ratio is over 100%, meaning they are paying out more than they earn. The third important factor isn't a single metric but a trend: dividend growth. Look for companies that have a history of consistently increasing their dividend payments over time. A track record of dividend growth shows the company's commitment to returning value and its ability to generate growing profits. It also means your income stream from the investment is likely to increase over the years. A well-known example of companies with strong dividend growth are the dividend aristocrats. These are S&P 500 companies that have increased their dividend every year for at least 25 consecutive years. Investing in companies with a history of dividend growth can provide both a rising income stream and potential for capital appreciation as the business grows. These metrics together give you a much clearer picture than just looking at the dividend yield alone. Given the characteristics of dividend stocks, who is this type of investing best suited for? It's not the right strategy for everyone, but it can be perfect for certain types of investors with specific goals. Dividend investing is often ideal for investors seeking passive income. If your goal is to generate regular cash flow from your investments, dividend stocks are a direct way to achieve this. This can be particularly appealing for retirees or those nearing retirement who need income to cover living expenses. It provides a predictable stream of cash. It's also well suited for investors seeking long-term growth, especially when combined with dividend reinvestment. While individual stock price growth might be slower than pure growth stocks, the compounding effect of reinvested dividends can lead to substantial wealth accumulation over decades. The total return from dividends plus modest price appreciation can be very competitive over the long haul. Patience is key with this approach. Dividend stocks are often associated with investors who prefer stability. Many dividend-paying companies are large, established businesses with stable earnings. They tend to be less volatile than smaller, high-growth companies. If you're uncomfortable with significant swings in your portfolio value, dividend stocks might offer a smoother ride. Finally, dividend investing is excellent for investors comfortable with a buy and hold strategy. This approach works best when you hold stocks for many years, allowing dividends to compound and ride out market fluctuations. Trying to time the market with dividend stocks is generally not recommended. The power comes from long-term ownership and reinvestment. So, if you prioritize income, value stability, are investing for the long term, and are happy to buy and hold, dividend investing could be a fantastic fit for your portfolio. It's a strategy focused on consistent returns and compounding wealth over time. As a beginner, it's easy to fall into common traps when starting with dividend investing. Being aware of these pitfalls can save you a lot of money and frustration. One major mistake is chasing high yields blindly. A stock with a 10% or 15% dividend yield might look incredibly attractive, but it's often a red flag. As we discussed, an unsustainably high yield can signal that the company is in trouble and the dividend is likely to be cut. Always investigate why the yield is so high. Another mistake is ignoring the company's fundamentals. Just because a company pays a dividend doesn't mean it's a good investment. You need to look at its earnings, debt, industry trends, and competitive position. A company with weak fundamentals might not be able to sustain its dividend, no matter how appealing the current yield looks. Bad businesses can cut or eliminate dividends without much warning, leaving you with a declining stock price and no income. Always do your research beyond just the dividend numbers. Don't put all your money into just dividend stocks or even just a few dividend stocks. Diversification is still incredibly important in dividend investing. Spread your investments across different companies, industries, and even asset classes. This reduces your risk if one company or sector performs poorly. Relying too heavily on a few high-yield stocks can be particularly risky. A diversified portfolio of quality dividend payers is much more robust. Finally, don't forget about total return. While dividends provide income, the stock price can still go down. A stock with a high dividend, but a consistently falling price might result in a negative total return. Focus on companies that can potentially grow their earnings and stock price over time, in addition to paying dividends. Avoiding these common mistakes will help you build a more resilient and successful dividend portfolio. It's about smart selection and diversification, not just chasing the highest yield. So, let's circle back to our original question. Are dividends a good investment? For beginner investors looking for stability, passive income, and long-term growth through compounding, the answer is a resounding yes. Dividend investing offers a tangible way to receive returns from your investments, providing income and contributing significantly to your total wealth over time. It's a strategy built on patience and consistency. It's not about getting rich quick, but about building wealth steadily and reliably. By focusing on quality companies with sustainable and growing dividends, you can create a powerful income stream and grow your capital. Remember to look beyond just the yield and consider the company's financial health, payout ratio, and dividend growth history. Do your research and diversify your holdings. If you're just starting out, dividend stocks can be a great way to ease into the market and understand the power of compounding. They offer a different path to wealth building compared to purely growth-focused strategies. Ready to start exploring dividend investing for yourself? The best way to learn is to take action. Begin by researching some well-known dividend-paying companies or dividend-focused exchange-traded funds, ETFs. Look at their dividend history and key metrics. If this video helped you understand dividends better, please give it a thumbs up. It helps us know we're providing valuable content. And if you haven't already, hit the subscribe button and notification bell so you don't miss our future videos on making investing simple and smart. We cover all sorts of strategies for beginners. We'd love to hear from you. Drop a comment below and let us know. I'm ready for dividend income. Or share your biggest takeaway from this video. Want to see some specific examples of dividend stocks? Check out our next video where we discuss some potential dividend stock ideas for beginners. Thanks for watching. This is where smart investing starts simple.